Hey everyone, welcome back to Corporate Decoder. Today we're diving into a filing that talks about splitting things up, kind of like a corporate divorce. But for stock, you're going to want to see what happens when units decide they want to trade separately. So we're looking at Bitcoin Infrastructure Acquisition Corp Ltd, a company that's basically a shell company, often called a SPAC, created to buy another, already existing business. They are letting everyone know that their units, which are made up of shares and warrants, are going to start trading on their own. Think of it like this: they sold these packages called units, and inside each package were two different things: a share of the company and half of a special option called a warrant. Now they are allowing people to take these packages apart and trade the share and the warrant separately. This usually happens after a certain amount of time has passed since the company first went public. These units, shares, and warrants will be trading on the Nasdaq stock market. The original units will still trade under the symbol BIXU, but once they are separated, the shares will trade under BIXI and the warrants will be BIXU. This might sound a bit technical, but it is important because it makes it easier for investors to buy or sell just the shares or just the warrants if they want to. The filing also lists a bunch of these specific classifications, like membership in a specific class of units. It's a way the SEC wants companies to categorize their different financial instruments for reporting. In simpler terms, it is just the official naming convention for what they are offering. Then we have the ordinary shares, specifically Class A ordinary shares. The important part here is the par value, which is a very small number, $0.001 per S-share. This is mostly an accounting term and doesn't reflect the actual trading price of the stock. And finally, the redeemable warrants. Each full warrant gives you the right to buy one Class A ordinary share at a price of $11.5. This is a key detail. If the stock price goes above $11.5, these warrants can become quite valuable because you can buy the stock for less than its market price. The announcement date for this separation is the 12th of December. This indicates when the company is informing the public about this upcoming change, and the actual separation is expected to happen around the 17th of December. To read also a section here about other types of filings. Companies sometimes use a Form 8K to announce all sorts of things, not just financial news here. They are just confirming that this report is not intended to fulfill any other specific filing obligations, like those related to soliciting materials or pre-commencement communications. It is a standard part of the form to clarify its purpose. An interesting point is that this company is checking the box to indicate it is an emerging growth company. This means they can follow some less strict reporting rules, especially when it comes to financial accounting standards, for a period of time after they go public. It's a way to ease the burden on newer companies. The filing also includes an exhibit, which is essentially an attachment. In this case, it is the actual press release that was issued on the 12th of December. This press release contains the official announcement detailing the separation of the units, and the report is signed by Ryan Gentry, who holds the title of Chief Executive Officer. This is the top executive confirming the accuracy of the information presented in the filing. Now let's put on our investor hats and think about what this really means. What is the story here? This company, Bitcoin Infrastructure Acquisition Corp Ltd, is essentially letting its investors know that they can now break apart the investment packages they bought. Before, to get the shares, you also had to buy the warrants. Now, you can choose to keep both, sell just the shares, sell just the warrants, or even sell some of each. This move is typically made to increase liquidity and provide more flexibility for investors. When units separate, it can sometimes lead to increased trading activity because more investors might be willing to buy shares or warrants individually rather than as a combined unit. For investors who are bullish on the company's future and believe the stock price will rise significantly above $11.5, those warrants could become very attractive. They are essentially a bet on future stock performance, offering a leveraged way to benefit from an increase in the share price. However, it is crucial to remember that this filing doesn't give us any new financial statements or performance figures. It is purely an administrative announcement about the trading structure of the securities. The real question for investors becomes, what is the underlying business that Bitcoin Infrastructure Acquisition Corp Ltd plans to acquire or has acquired? SPACs are often criticized for their lack of transparency regarding their acquisition targets until the very last minute without knowing what business they intend to merge with. Evaluating the true value of these shares and warrants is purely speculative. The fact that they are an emerging growth company is a double-edged sword. It allows them flexibility, which can be good for a startup, but it also means less detailed financial disclosures than more established companies. This can make it harder for investors to do their due diligence and understand the true financial health and risks involved. Looking ahead, investors should be watching for any announcements about potential acquisitions. That's when the real story of Bitcoin Infrastructure Acquisition Corp Ltd will begin to unfold. Until then, The value of these separate trading securities will largely depend on market sentiment and speculation about future business combinations. So, what's my take on this? This filing is all about unlocking flexibility for investors, which is generally a positive step. It signals that the company is moving forward with its plans. However, the real substance, the actual business operations and financial performance, is still largely a mystery. The risks here are the typical SPAC risks, an uncertain acquisition target, potential dilution from warrants if exercised, and the general volatility associated with companies in this stage. The opportunity lies in a successful acquisition of a promising business, which could then lead to significant gains for early investors, especially those who might take advantage of the warrants. For now, it is a situation that requires investors to have a high tolerance for risk and a lot of patience while waiting for the acquisition to be revealed. Alright, that's our decode of this filing. What are your thoughts on this unit separation and the future of SPACs like these? Let us know in the comments below. If you found this breakdown helpful, please smash that like button and subscribe for more. And don't forget to join our Discord community for more in-depth discussions. The link is in the description. Thanks for watching, and we'll see you in the next one.